Before you buy a small business, you're not purchasing past profit, you're buying a stream of uncertain, future cash flows. Stress testing shows how that cash flow behaves when the real world stops following the seller's best case story. In this session, we'll build a simple baseline and run 5 practical scenario models: a volume swing, a price compression, a cost spike, an operations disruption, and a cash cycle crunch. Each model asks, if X happens, what happens to EBITDA, cash, and covenants, and what would we do about it? The goal is twofold: to decide whether to walk, renegotiate price and structure, or proceed with confidence, and to identify the exact operating levers and early warning signals you'll need on day one. We'll keep the math simple: units, price, variable cost, fixed cost, so the focus stays on decisions, not spreadsheets. By the end, you'll have a repeatable checklist to pressure test any Main Street business in a few focused hours. Start with a 1-page baseline model. Capture trailing 12 months for a typical month: units sold, average price, variable cost per unit, contribution margin, and fixed operating costs. Add 3 lines underneath: break-even units, operating cash cycle in days, and headcount by function. Example: a neighborhood coffee roaster sells 10,000 bags per month at $12 each. Variable cost: beans, bags, shipping, averages $6.50 per bag, so contribution margin is $5.50. Fixed costs: rent, salaries, utilities, software, total $38,000 monthly. Break-even equals fixed cost divided by contribution margin, so 6,909 bags. Add a quick cash cycle: 10 days inventory, 5 days receivables, 20 days payables equals -5 days net. Helpful. This baseline is your anchor. All scenarios flex one or more of these knobs and read through to gross margin, EBITDA, and cash. Keep it visual and simple so assumptions are transparent and easy to challenge. Volume is the most common shock. Model a 10%, 20%, and 40% drop in units. Keep price and variable cost per unit constant first to isolate the effect. With our roaster, 20% fewer units means 8,000 bags. Contribution drops to 8,000 times $5.50 equals $44,000. Subtract fixed costs of $38,000 and EBITDA falls to $6,000 versus $17,000 at baseline. At 40% fewer units, 6,000 bags, contribution is $33,000, below fixed costs. EBITDA turns negative at -$5,000. Now add second-order effects. Lower volume may increase variable cost per unit due to lost scale on shipping, and can lower average price if you run promotions. Test a 1% price dip and a 25 cents increase in variable cost simultaneously. This reveals the margin of safety, how much volume you can lose before EBITDA or covenant thresholds break. The output is a trigger point for action, not a prediction. Test the upside, too. A sudden 30% lift to 13,000 bags sounds great, but capacity, quality, and cash can wobble. Add a capacity line to your model: maximum daily throughput without overtime, rework, or missed SLAs. If baseline labor and roaster capacity caps at 10,800 bags, the extra 2,200 require overtime or outsourcing. Model an overtime premium that raises variable cost by 40 cents per unit above the capacity line and a 1% waste factor that reduces sellable units. Check working capital. More inventory and receivables can absorb cash, even when EBITDA rises. Add a note for lead times: beans might be 4 weeks, so rapid demand spikes cause stockouts unless safety stock rises. Actions list: introduce minimum order quantities, stage temporary labor, pre-negotiate third-party toll roasting, and protect top-margin SKUs first. The scenario isn't just about revenue, it's about protecting service levels and cash. Next, simulate a price war or buyer pressure. Take 3%, 5%, and 10% price cuts and recompute contribution. With 10,000 bags, a 5% cut lowers price to $11.40. Contribution per unit drops to $4.90 if variable cost stays $6.50. Monthly contribution becomes $49,000, down from $55,000, taking EBITDA from $17,000 to $11,000. Add realistic cross effects. A price cut may lift volume, try plus 5% units, yet mix can deteriorate as lower margin SKUs dominate. Create a ladder. For each 1% price drop, what volume increase do you need to hold EBITDA flat? Solve graphically by plotting EBITDA isobars versus price in units. Also, test a floor, the lowest price that still covers fixed costs under reasonable volume. This reveals whether the business has pricing power or lives at the mercy of competitors and key accounts. Use the model to plan defenses. First, protect mix. Identify top 20% SKUs or customers that contribute 60 to 80% of margin. Draw a line, these do not get blanket discounts. Offer value-adding bundles, subscription, faster ship, or extended warranty, instead of raw cuts. Second, test selective increases. Can you raise prices 2 to 3% on low elasticity items to fund sharper pricing where needed? Third, tighten discount governance. Require approval for deals below the modeled floor price. Tie sales comp to contribution dollars, not top line. Fourth, compare price cut versus cost out. Would a packaging change save 20 cents per unit with no customer pain? Finally, monitor early signals, competitor flyer prices, lost quote logs, and customer purchase order frequency. The scenario clarifies which levers produce equal or better EBITDA than chasing a race to the bottom you cannot win. Now assume a 15 to 30% jump in a key input, beans, freight, or labor. Push variable cost per unit from $6.50 to $7.50 and $8.45 in 2 steps. At $7.50, contribution per unit drops to $4.50, EBITDA falls from $17,000 to $7,000 at constant volume and price. At $8.45, contribution per unit is $3.55, EBITDA is slightly negative and less fixed costs flex down. Add a tornado chart ranking sensitivities, which inputs move EBITDA the most. If freight is small, focus on beans and labor. Then time profile the spike, sudden for 3 months or stair step for 12. Tie cost to indices if available so you can test pass-through clauses. Also model quality slippage if you downgrade inputs. A 30-cent savings may lift returns and customer churn, feeding back into volume and price pressure. Cost spikes rarely travel alone. Anticipate secondary hits. Plan responses on 2 horizons. Short term, test a temporary surcharge or fuel fee, communicating it as index-linked and time-bound. Run a pass-through model. If you lift price by 3% and lose 2% volume, does EBITDA improve versus absorbing the shock? Pair it with small, quick wins, renegotiate shipping tiers, consolidate suppliers for a 2% rebate, and reduce scrap by tightening QC checks. Medium term, redesign. Can you change bag size, re-engineer recipes, or automate a manual step to remove $0.30 $0.60 per unit structurally? Model payback periods. If a $25,000 semi-automatic filler saves 15 cents per bag at 10,000 units per month, payback is about 17 months before tax. Include switching risks, trial batches, customer acceptance, and certification lead times. The test tells you whether the business has credible levers to neutralize inflation or will bleed margin under pressure. Assume a critical machine failure, supplier outage, or 20% labor absenteeism for 4 weeks. Map the process: receiving, roasting, packing, shipping. Place a red X on the roaster or packer and cut effective capacity by 30%. Model backlog accumulation, orders versus throughput per day. As backlog grows, lead times extend, and some customers cancel, trimming volume and future loyalty. Add quality risk. Rushed overtime can elevate defect rates by 1 to 2%, creating rework costs. Convert this into dollars: overtime premiums, expedited freight to meet deadlines, rental equipment, and contractor rates. Now overlay SLA penalties or lost wholesale slots. Focus on time to recover, days to repair, vendor lead time for parts, and availability of a backup supplier. The purpose is to find single points of failure and quantify how quickly they turn profits into losses under stress. Turn the disruption model into a resilience plan. Identify buffer stocks for the top 3 SKUs with the highest margin per minute of machine time. Compute minimal safety stock in days that keeps service above 95% for a 4-week outage. Document pre-approved vendors for toll production or rental gear, with pricing and response times. Cross-train roles so a 20% absence doesn't halt packing. Add preventive maintenance intervals and a spare parts kit list with cost versus downtime value at risk. Define triggers. When VIP queue hits 2 days, activate overtime. When lead time exceeds promise by 50%, shift orders to backup. Include customer communication templates that prioritize key accounts first. Then stress the cash angle. Estimate the working capital spike when you build buffers. The test proves whether resilience can be bought cheaply in advance or demands structural investment baked into your acquisition price. Many good P&Ls fail in cash. Stress the cash conversion cycle. Extend receivables by 15 days, lengthen inventory by 10 days due to safety stock, and watch payables tighten by 5 days if suppliers demand better terms. Compute the net day swing and translate to dollars. At $120,000 monthly COGS, each day of working capital is roughly $4,000. A 30-day swing ties up $120,000, often more than the cash on hand. Add debt service, plot your fixed principal and interest. Then pull EBITDA down by 20% in a combined shock and recalc your interest coverage and total leverage covenants. If headroom disappears, test levers, early pay discounts to pull cash in, dynamic discounting, a small revolver, or inventory finance. Also quantify customer concentration risk. If one buyer at 35% of our stretches to 75 days, model the survival plan. Cash timing, not averages, decides outcomes. Compile results in a single page. For each of the 5 models, mark worst-case EBITDA, cash draw, and time to recover. Color code green, yellow, red. If multiple reds cluster, you either walk or reprice. Translate findings into deal terms: lower enterprise value for thin margins, seller financing with offsets for undisclosed churn, earnouts tied to revenue quality, or a working capital peg that reflects realistic inventory and R. Tie operations fixes to day 1 actions, price governance rules, supplier consolidation, maintenance kits, backup vendors, and a 13-week cash forecast cadence. Add early warning metrics: quote win rate, lead time variance, gross margin by SKU, are over 45 days. A disciplined stress test doesn't predict the future, it sets guardrails and playbooks so surprises are survivable. That's how you buy with eyes open, protect downside, and keep upside optionality intact.